Are those earnings estimates already built in? Is that what happened to the market last week?
Some of that was what happened to the market last week. I think it was also some of what we're seeing in the data on the producer price index, showing that the Fed may be still a little bit more hawkish when we get into the meeting this week. But I think when you look at it, prices do still have to come down probably a little bit. You're seeing that companies are obviously still battling with inflation. There might be a deterioration of demand in some sectors, and companies, maybe and analysts are looking at the numbers, and we're all saying, are we sure that we priced everything in yet? Not so sure that we have. And so if you look at the valuations, especially in the tech sector, they have come down from kind of the crazy valuation of 2021, but we may still have a little bit more to go, Brian.
Yeah, I mean, and the numbers are coming down pretty quick, but the it's been what, terrible year. I mean, not just for stocks, but for bonds, one of the worst combo years ever when you look at all asset classes all in. Do you think that earnings estimates could get worse from here on out, or maybe the worst for the macro markets has already been priced in?
I think, when I'm looking at it, I think still in Q1, we still have a little bit to go. And I think we still could see a deterioration. That's why you're seeing that kind of revision down. I think companies in the quarter three have all pointed to, the fact that there's the outlook in the next 3 to 6 months could still be a little bit cloudy. I think once you get past that and you start looking at what could happen when we see a consumer that has gone through the worst of it, and the consumer that has gone through a little bit maybe higher unemployment rate and has still been able to potentially keep the personal balance sheet somewhat strong and rebound from that. And then you see demand come back because a lot of the policies have been enacted, especially if you look at what's going on in the housing sector. That's still lagging, and some of that stuff still hasn't come through. And I still think we're going to get to that. And to see how we all react from that will be kind of big, especially when we come to the markets and what kind of recovers faster, which I think will probably be crypto and then equities, and then we'll go from there.
Obviously, Wall Street strategists, we have them on CNBC all the time. They're our friends. Some of them are even kind of our colleagues, contributors, whatever. So we're not knocking them, Delano, but pretty much every single major Wall Street strategist got this year spectacularly wrong.
Yeah.
I think the low estimate on the S&P 500 was 4,700, going up to like 5,300. Obviously, unless we get some insane buying the next 2 weeks, we're not even going to be close to that. Now we're starting to see 2023 forecasts come in, Delano. Goldman Sachs, they see the stock market declining. We're going to see a lot of negative takes on 2023. How do you kind of read the macro environment right now?
Yeah, I'd like to say first, even I was definitely wrong. When I looked at 2022, I think I saw less than double-digit gains, but I was around the 6 or 7% range on the S&P 500. And so, yeah, we, pretty much from what I've seen, a lot of us have got that wrong. Now, taking a contrarian view, when I look at 2023, I do think the first 2 quarters, I think, will be rough. And now, when you see everyone kind of a consensus showing, bearish, I think I kind of like to go the other way in that respect. I think we'll potentially we'll definitely see a better year than we did in 2022. Yeah. I do think that after the first half of the year, we'll get to a place where we've seen rates kind of moderate, pause, and then kind of go down. A consumer that's a little bit stronger, and earnings that kind of start to go up for companies, and then we could potentially have a positive year for 2023.